Hello everyone, I am Dilini. The topic of my presentation is identifying the levels of investment risk of CAC listed companies using cluster analysis. This research was conducted under the supervision of Dr. U.P. Leenage, Department of Statistics and Computer Science, University of California. This is the overview of the presentation. Introduction. Decision making in investment planning and management is a difficult practice, particularly in stock investments. Randomness is the regular nature of a stock market. Therefore, decision making on stock investments require proper knowledge derived based on scientific methods. The ideal objective of an investment is to gain high returns with low risks, which is seemingly impossible as high returns can only be expected with high risks in practical scenarios. So, risk and return should be evaluated simultaneously for effective decision making. Investing at Colombo Stock Exchange. In this study, we have analyzed the stock investments at Colombo Stock Exchange. It is the main stock exchange in Sri Lanka with an online trading platform. Objectives. It is to formalize a systematic procedure to select a set of companies from CSC to form optimized investment portfolios. So, what is a portfolio? We call a collection of financial assets selected for investing as a portfolio, and this collection should meet up the investor's expectations. So, selecting this collection upon the expectation is the main challenge. On that account, we need some quantitative methods. Let's see what we have in literature. We can see company clustering had been implemented in several many studies, and also in different literature, different methods had been used to measure similarity or the dissimilarity between the entities. Also, many researchers had suggested different selection algorithms to select companies from clusters to portfolios. Methodology. Diversification among assets lowers the risk of an investment than investing on an individual asset. In this study, our approach is first to identify classes of companies with similar risk and return levels. For that, we use clustering. Then we define algorithms to select companies from clusters to portfolios along with optimization. Data. As I have mentioned above, we have used historical data of companies listed on CAC. So we collected data from CAC data library for the period of 1st of January 2014 to 31st of December 2018. Also, we have collected data on treasury bill rates from Central Bank of Sri Lanka. A main part of the study is based on cluster analysis. So let's see what cluster analysis is. It is a unsupervised learning technique for classifying individuals or objects into mutually exclusive subgroups based on the similarities among the entities. In this diagram, you can see the classification of clustering techniques. In this study, we have used both hierarchical clustering and k-means clustering using standard inbuilt function in R. Model adequacy and validation. As a first step in cluster analysis, we need to check whether the datasets are clusterable. Then we need to identify the number of significant clusters lies among the entities. So we use these standard techniques for that. Then most importantly, we need to validate and check accuracy of our cluster models. Here we use Dunn's index as an internal validation method. And to measure the accuracy, we can use the between sum of squares to total sum of squares ratio. Portfolio optimization. As we discussed above also, a portfolio is a grouping of financial assets, and portfolio optimization is selecting the best portfolio with optimized risk and return. Mean variance model. This is a standard method introduced by Harry Markowitz for calculating asset allocation and optimizing return and volatility. Quadratic programming. The optimization technique used in mean variance model is quadratic programming. Formation of portfolios. So far, we have discussed about clustering companies and creating optimum portfolios. So how do we select companies from clusters to portfolios? We need some procedure or some algorithm. So let's discuss about that. Monte Carlo simulation. In the simulation method, a large number of random trials are implemented and observe the distribution. How to identify the dissimilarities? So here we use three variables for that purpose. First one is Sharpe ratio. It measures the average return earned in excess of the risk-free rate per unit of volatility. This is an example time series plot of weekly Sharpe ratios. Beta. It is a measure of systematic risk of an individual stock compared to the unsystematic risk of the entire market. And this is an example time series plot of beta ratio. Alpha ratio. It measures the performance of an investment relative to a suitable market index. This is the time series plot of weekly alphas of John Keel's holdings. Share price. It is the highest price someone is willing to pay or lowest price it can be bought for. The first graph shows the daily share prices of John Keel's holdings, and the second one shows the daily continuous compound returns of the procedure of the analysis. This is a summary of how we used variables throughout the analysis, and except using the original variables, we use the norms of them. As the first stage of this study, 7 cluster structures were constructed with different combinations of the 3 variables. There are 7 models, and these are the definitions of those 7 models. Formation of portfolios. When selecting companies from clusters, the first thing we need to decide is how many companies are to be selected from each cluster. As we know, there are a number of ways to select n elements from different groups. To consider all possible cases, we developed an algorithm, and then for each case, we select a random sample of companies and carried out the optimization. There is a limitation of this method as we select only one random sample from each case, and it can be an extreme case. So we developed another algorithm. In the new algorithm, we select many random samples from each case and take the average risk and return values for the corresponding case. Results and discussion. First, let's see the findings of cluster structures. First, we check the clustering tendency for all combinations of variables, and there were evidence that all those datasets are clusterable. Here you can see the results of model 1. The representation using VAT image also provide evidence for clusterability. Then we found the optimal number of clusters using these 3 methods. Then we cut the dendrogram at K we found in the previous step. Next we feed the cluster centers obtained in the above step to K-means algorithm as initial cluster centers. Here you can see the cluster plot of final cluster structure under model 1. The first table represents the cluster centers of each cluster in terms of the 3 variables. The second table shows the level of volatility from cluster 1 to cluster 5. Here we can observe both Sharpe ratio and beta increases from cluster 1 to 4, while cluster 5 has the lowest Sharpe and highest beta, which may represent an extreme class of companies. So we implemented the same procedure for other 6 models. In the second model, also volatility increases from cluster 1 to 5. Here also cluster 5 shows a deviation from the rest. In model 3, cluster centers increases from cluster 1 to 5 in terms of both Sharpe and alpha. In model 4, the cluster centers increases from cluster 1 to 5 in terms of both alpha and beta. From model 5 to model 7 are univariate models. In each model, cluster centers increases from cluster 1 to 5. Simulating random portfolios. So here we first use algorithm 1. We considered 10 companies for each portfolio and identified 1001 random portfolios covering all possible selection cases using algorithm 1. This graph represents the risk and returns of those 1001 portfolios. Here we can observe at the rightmost corner of the graph, return is higher than risk, and when moved to right, the gap between the two curves reduces, and at one point the risk starts to dominate, and at the rightmost corner of the graph we can observe very steep curves. Here the first table shows the weight allocation of top 5 portfolios with highest returns. We can see that cluster 4 has contributed the most in optimizing the return. At the same time, when we take portfolios that do not contain companies from cluster 4 but contain companies from cluster 3 contributes most for optimizing return. Likewise, we can order the level of contribution in optimizing return as shown in the second table. As I mentioned above, the previous algorithm can be affected by extreme cases. So we consider the average case using algorithm 2. Here we select many portfolios from each criteria and take the average case. Plot 1 illustrates when 18 random portfolios were selected from each case, and plot 2 illustrates when 50 portfolios were selected from each case. As they represent similar behavior as in algorithm 1, we can justify the results in previous method as well. Here also we can see similar behavior of contribution from clusters in optimizing returns. Conclusions. Norm of quarterly Sharpe ratio alpha and beta are appropriate for calculating clustering companies and identifying level of investment risks. The complete set of selection criteria could be identified, and that procedure gives 5% higher return than solely depending on random methods. The distribution of risk and return was identified for all selection criteria, so the investors can select companies according to their risk profiles. As a final conclusion, quantitative procedure for minimizing the qualitative impact on the selection of assets of a portfolio has been proposed and tested with the context of CSC. These are the references for theories and concepts used. Thank you everyone for your attention and valuable time.